something you can do with investment ISAs is you can hold like cash funds in investment ISAs. They've sort of closed that loophole, haven't they? So interest is even on investment ISAs will then be charged.
That interest is liable to be taxed now at 22%.
22% as well. That's so random.
Just to make things a little bit more tricky for everybody, which is what unfortunately chancellors tend to do to us at the moment. It feels like. So at the moment, you can pay £20,000 into a cash ISA, but from April 2027, if you're under 65, that will be reducing to £12,000. So there's going to be an £8,000 reduction in the amount that you can pay into a cash ISA. Again, the idea there being that 8 may go into a stocks and shares investment ISA to generate economic growth and all the rest of it.
Yeah, one of the cheesy phrases I always like is don't let the tax tail wag the investment dog. Just because you're going to incur tax on something doesn't mean you shouldn't then sell that thing. If those shares aren't right for you, then it's worth it may well be worth incurring the tax to then reinvest it into something that does suit you. Hello and welcome back to Financial Illumination, a podcast from the team here at Lumin Wealth. My name's James Corcoran. I'm very excited to be with you today. We are going to be talking about ISAs and the changes coming up, general investment accounts, what you can be doing to maximize your growth, thinking about the changes that might be coming up. I'm very excited today to be joined by Jack Dudley. How you doing, Jack?
I'm all good, James. As always, sweaty, hot, had enough of the hot weather. Any chance of this abating? I've absolutely voluntarily had enough, which I'm sure we all have. Yeah.
Yes, yeah, no. Although with this lovely new studio we're in London is it's lovely and air conditioned. Well.
It's very comfortable.
It's not too bad at all. But yeah, so we're here today to talk about ISAs and savings and general investment accounts and all exciting stuff like that. I think there's a lot of changes on the horizon. You might have noticed there's a new Prime Minister.
Again.
And again.
Yeah, a
another
new
one
Chancellor.
Of those.
Again.
Yeah. We get quite a few of those these days. But so we've got a new one. Andy Burnham's in. And there has been a lot of rumour and speculation of what could be happening with various taxes. It seems like there's new announcement coming out all the time. But today we really just wanted to focus on savings ISAs, which was a sort of an announcement from one of the previous regimes. Can't remember which.
Take your pick.
Take your pick,
Yeah.
and what people can be doing. Some real top tips about how to maximise their savings, to trying to get the most they can, and being aware of the new rules that are coming in. Yeah. So do you want to just give us a quick breakdown of where we are currently with ISAs? That's cash ISAs, stocks and shares ISAs. And what's going to be changing from April next year? Yeah,
absolutely. I mean, I think the key place to start is, as we always say, speculation is never anything we will act on, and nor should you if you're listening to this. It is a little bit hairy at the moment, and it feels like it has been for a few years. Obviously, we had the budget, I think, in 24, which was the big sort of almost cataclysmic one around pensions and estate planning and the treatment of IHT and all the rest of it. But obviously with the budget coming up this autumn, we'll have to wait and see what happens. But as the land lies currently, obviously at the moment, as we know, we can pay £20,000 into a combination of ISAs across the board. So you could have 10 into a cash ISA, and then you could put 10 into a stocks and shares ISA. An important point, again, a bit of a misconception that we find, is that's only new money. So if you have ISAs that you're moving from one to another, from A to B to C, etc., that does not constitute your £20,000. It's only from new cash. So that's quite a common thing. So for example, if you had £100,000 in a cash ISA and then you move that to a different cash ISA, you can still add in 20,000. Now, the big change with ISAs that came in at the last budget, and I think that must have been Reeves, surely.
I think it was Reeves.
I think it probably was back then. I don't know. There's been so many changes recently. There was a bit of a cap introduced into how much people could pay into a cash ISA. The logic behind that, not too sure. It really I think the idea there was just to kind of make people feel incentivized to invest money. But again, we can probably go off on a bit of a tangent there, which we won't do. Now, that's been capped, and that cap starts in 2027. So from April 2027, there will be a change as to how much you can put into those different types of ISAs. So at the moment, you can pay £20,000 into a cash ISA. But from April 2027, if you're under 65, that will be reducing to £12,000. So there's going to be an £8,000 reduction in the amount that you can pay into a cash ISA. Again, the idea there being that 8 may go into a stocks and shares investment ISA to generate economic growth and all the rest of it. So that's the biggest change so far. So for this year, of course, it's the last year that anybody listening to this that's under 65, it's the last year that if you do contribute to cash ISAs and you're able to max that amount out every year, is the final year that you can put 20,000 in, £20,000 into the cash ISA. That might change again in the future. We don't know. We're just constantly working on this hamster wheel of legislation change at the moment, it feels like. But that's the first place to start with regards to legislation changes coming up.
Yeah, absolutely. And I think the big issue there, when you think about, okay, well, that's really, well, what is behind it? And to be honest, I was quite happy with that because a lot of people put money into cash ISAs. And yes, I agree, for the right person, it does make sense to have money in cash ISAs. If there's a specific goal for that money, you want to get the tax-free interest, you don't want to see any potential chance that could drop.
Yes.
If there's a specific goal. So, for instance, I've used cash ISAs for my children going to university age.
Yeah.
Okay, there's a specific requirement, right?
Yeah.
We need to be having that money. I can't then say, oh, sorry, can't go to university because the money that we put aside has just dropped 40% because we've had another COVID or we've had another whatever.
Yeah.
So where there's a specific goal for that money, yes, that makes sense. But I think that in a lot of terms, though, actually just having an investment ISA generally will do better. And I think that what the government, I think, was trying to do was really just trying to encourage people to get that better growth, because the more growth that they achieve, the more money they will then likely have in retirement, and the less chance they'll end up being reliant on the state.
Yeah.
And so I think that the idea of it, I think, is quite good. It's just, and I was reading Martin Lewis, an article on this. He always talks about prefer the carrot and the stick. And it feels like this is a bit more of a stick approach, where they're saying, no, you can only put in 12,000.
Yeah.
One of the things that came up that we were sort of, often when these things happen and you look at, right, well, okay, well, where's the loopholes? Where's the potential ways around it? What could people do? And, something you can do with investment ISAs is you can hold like cash funds in investment ISAs, and that works. But they've sort of closed that loophole, haven't they? So interest is even on investment ISAs will then be charged. Yeah,
this was obviously a big talking point, and it took a few days, didn't it, to kind of come out, as these things tend to do. It's never an immediate, okay, these are the facts, this is how we've interpreted it. It's very black and white. It took a little bit of a while to kind of circumvent that. Now, as part of that change in terms of the cap, there is, as you say, James, there is going to be a potential. Well, there's not a potential as it stands. It's happening. There will be a tax on interest that is earned on cash funds within a stocks and shares ISA. So effectively, what you were saying there, of course, is people were looking to potentially use the £8,000 reduction in the cap that they could pay into the cash ISA by holding £8,000 in a stocks and shares ISA that would generate them interest. So again, there's no investment there. Government have gone, hang on a minute, we need to sort of have a look at this, because actually people have started to figure out a way around it. So any tax, or rather any interest that's earned on that, if you did put that money into a stocks and shares ISA that was generating interest, that interest is liable to be taxed now at 22%.
22% as well. That's so random.
I don't understand. I just don't get it.
It's not like in line with your normal income or 20%.
Yeah.
22.
Yeah.
Okay.
Why not? Absolutely. Just to make things a little bit more tricky for everybody, which is what unfortunately chancellors tend to do to us at the moment. It feels like, but so cash will be. Any interest that you earn on that cash will be taxed at 22%. And now, obviously, what we're trying to now work out is how that's going to be reported, how people pay it. And it feels like we're kind of still at a point where we don't have all the stones turned over to kind of give us answers to that. So, as you say, a little bit of a loophole that people were thinking about exploring. And this applies to cash holdings, money market funds, etc. So anything cash related that you could obviously hold within an investment vehicle, be that ISA we're talking about at the moment, or even a pension, that is also going to be liable to tax. Now, obviously, the question mark comes there of, hang on a minute, I thought ISAs were tax-free. So it kind of blurs the lines a little bit between actually, is this still a fully tax-free wrapper? Because at the moment, obviously, growth is tax-free, dividends are tax-free, capital gains or any sort of, gains that are realised within the ISA, there's no taxable element to that. And now it's starting to kind of seep through a little bit to kind of have this idea that, are they fully tax-free anymore? So I don't know your thoughts on that. It feels a little bit
Yeah, I know what you mean. It's what you sort of deem to be a tax-free product, and then you say, tax-free but asterisk.
Yes, small print stuff, isn't it?
Exactly, I know. So it's frustrating, but like I said, for me, like if it means that people will then think about investing more, I think, as I said, there are those people that don't want to invest. It doesn't suit them. It doesn't suit their risk profile. 100%. That's absolutely fine, and that's then the right thing for those people. And those people are then going to be limited because the only other option, and if you want cash, is going to be using bank accounts which aren't ISAs, which aren't tax-free. And especially with the way that the income tax thresholds are frozen, so many more people are now paying interest on their cash and paying 40% on their cash. So often someone will come and say, "Oh, I've got 4% rate on this savings." And you think, well, it's not really 4% though, is it? Because you're paying 40% if your income is in excess of that. And so it just means that people are being driven into incurring tax on their savings so much more, which then you either have a choice. Then you say, well, I'm going to keep it on savings to keep the risk low, but then also be incurring more tax, or it is going to force people into investments, which isn't necessarily a bad thing because, like we said earlier, investing doesn't always mean high risk investing. There are plenty of options if people wanted to move into the investment space in their tax ISA, with the cash ISA moving into the investment space. But then not necessarily going 100% risk. You could go, we have an income portfolio, which I really like. It generates natural income through dividends. And then so those being paid out would then be tax-free. You
can almost substitute the interest.
Exactly, very similar to what people have been doing on interest. So there's premium bonds, obviously. If people haven't maxed out premium bonds, that's a really good option. But other than that, it is just a case of just weighing up the options. And if it is going to be then tax or move into investment world, that's the choice people have to make.
I do think though that there are, when things like this happen, it can feel very sort of hyperbolic in terms of the initial reactions. People sort of think actually this is really damaging. I'm not necessarily sure from my point of view that I agree with the change, but obviously your points there are valid as well. But I think sometimes it's a case of let's just take a step back and actually does it mean that we just need to come off the road a little bit sooner or go to somewhere else with those potential cash funds that we want to escape from having sort of taxed interest on them. But I think that boils down to, again, going back to the previous episode. So if you haven't listened to that, please do go back and have a look at it. It's around understanding what that potential pot of money is for, because it links to that financial plan, doesn't it? So I think generally in the conversations that I have, I tend to set my safety net at about 3 years. And by that, I mean anything that isn't necessarily needed within a 3-year period. Generally, that's the kind of switch point at times that inflation might start to take a bit of a hold on cash savings. What that does then do, going back to your previous point about that short-termism, is it prevents, loss of capital by fund reduction if you are investing money that you might need in the short term. But it's about working out what that time frame is. So anything sort of generally speaking, of course, this is obviously sort of just more of an educational piece at the moment, but anything coming up within a 3-year period, we tend to find actually, do we want to avoid any short-term movement in markets that mean that purchase or whatever that is not going to be doable anymore. So that can stay in cash and cash ISAs. But again, we need to look at the circumstances of the individual. Does it mean that then they're going to give rise to tax liabilities that they don't currently have? And is it just going to kind of muddy the water a little bit for them? So every little change that we're seeing at the moment does seem to have a little bit of a knock-on impact. And we just need to be clear and understand the circumstances. And again, that does come back down to having that initial discussion to make sure that what you're doing is right.
Yeah, I mean, coming to a similar point as well. So when we talk about ISAs, so you max out at 20,000, or like it's going to be 12,000 with cash ISAs. But when we're talking about investing, you have this opportunity to get 20,000 into a tax-free investment. Asterisk, as we said. But in terms of actually the growth and everything, so getting that money into a tax-free environment. But then often people come to us and they've maxed out their ISA. Maybe they've even maxed out their pension as well if they've had the opportunity to do that. But then they're sitting on a lot of cash because they didn't really know there was another option. I've done my investment ISA. What else can I do? So I think that's where often a general investment account might want to come into play. Do you want to just talk about that?
Yeah, so this can sit alongside an investment ISA. So typically we have what I call a waterfall system where we maximise the tax sheltered bits first. So like you said, the pension, stocks and shares ISA, cash ISA, whatever it may be, a little bit left over, don't really need it, it's deemed surplus. So we can look at what's called general investment accounts, and certain platforms will name them certain different things, but in theory they are an investment vehicle that sits alongside the ISA. The difference between the two, of course, is that the tax efficiency of the general investment account is nowhere near as good as the cash, as the ISA or the pension rather.
Sure.
So in theory, you can have exactly the same investments within an ISA and a general investment account, which people tend to kind of do because it fits risk profiles, etc. But there's no tax advantages to having, or very limited, I should say, probably in the general investment account side of things. So growth within that is potentially liable to what we call capital gains tax. And there's different rates of capital gains tax depending on your earnings and whether it's a property, shares, all the different things which we'll go into on another episode. But the key thing really that we want to bear in mind is that each tax year, an individual can only allow themselves a £3,000 capital gain, be that in an investment account, or some people we speak to have individual shareholdings that they've acquired from a company or whatever it may be. Anything over and above that £3,000 gain is taxable with capital gains tax. So as a really simple example, if you hold £3,000 worth of shares, they grow to 7,000, so you've had a £4,000 gain, and you sell those shares either in that investment account or as shareholdings, the first £3,000 is tax-free, provided you've made no gains elsewhere. That £1,000 above that threshold could be taxed and will be taxed at capital gains rate, whatever that is to that individual. Also, obviously, of course, you might find that you're getting paid dividends on those shareholdings or those funds that you have. Also not sheltered. So you've got a dividend allowance, again, depending on your earnings. Once you're over and above that, you'll be taxed dividend income as well. So there's a lot more sharks in the GIA water than there are in the nice clean pool of the ISA, so to speak. Yeah. So we do need to be really careful about that. Now, what a lot of people tend to do is we look, again, with the conversations that we're having, is understanding what the gains may be within those general investment accounts, and therefore using that, it's called a bed and ISA process, where we effectively sell down enough to cover that allowance. That can then be used to fund your ISA allowance for that particular tax year. Again, there's a huge amount of variability there because we don't know what the gain's going to be on all these shares. Sometimes people themselves don't know because it might have had a 20, 25-year period where they've just not done anything and the gain could be huge. It might have been the other way where that particular company is dropped or whatever it might be. So yeah, a lot of variability there, and that will need a conversation. And I would always sort of encourage those that are in that potential position where there might be a big capital gain just to have a chat with somebody to make sure that they're not falling into any traps there, as we talked about on the previous episode as well. So yeah, a lot to be aware of.
Yeah, and I think that the thing with capital gains as well is that it's just got worse and worse and worse over the years. So you know, it used to be you could have a £12,000 capital gains
not long
allowance.
ago either.
Not that long ago, no. And so it was, you know, so if you had a couple with a joint general investment account or a couple that had sold a property as like a rental property, then you'd have to go some way to actually have gains enough to give you a capital gains tax bill. You didn't see that many people incurring capital gains on investments. However, that's just come down and down and down to this point at 3,000. And as I said, at the moment, the capital gains rates are a bit lower than income tax rates. Yeah. At 18 and 24%, whereas obviously income tax at 20 and 40. And like we said, new Prime Minister, new Chancellor that have got things that they want to do. There's certain taxes that they've sort of said there's red lines they won't change. Capital gains tax is therefore potentially an opportunity for them. And, you know, and you could argue politically, well, is it fair that someone that's earning on income should pay a higher rate of tax than someone that's earned money through selling shares, selling investments, because generally it's wealthier people that sell. So, you know, from that, putting that hat on, you can understand the argument. But what there has been speculation of, and like we said, you know, we're recording this in early August 2026. We don't know exactly what's going to happen. There has been speculation for a few years now that at some point capital gains tax might then just be put into line with income tax. At which point, then obviously it's going to be significantly worse than it is now. Yeah. For people,
especially for higher rate too, right?
Especially for higher rate.
That jump from 24 to 40 is significant.
It's a big jump. Yeah. So I suppose we don't know. But you can probably have a fair guess that they're not going to make it not going to drop tax rates. Yeah. Generally, tax rates don't drop that much that often. So if it is to change, it probably will be up. So what do you think people could be thinking about looking into the potential for changes?
Yeah, I think it's a case of firstly understanding what that gain might be that you're sitting on if you do indeed have one. I think this is more prevalent, probably people that are owning second or third, fourth properties, etc., landlords that are renting property out, because obviously property gains, generally, if you're not making and you held it for a few years, it's likely that the gain on that property is going to be much more than 3,000. But it does apply to investment accounts and shares as well. So firstly, understanding that what can be done, because it can be a phased move, it can be a phased sell down. It doesn't all have to happen in every single tax year, if you see what I mean. We can look at actually staggering that out over a number of tax years. Another thing people can do, which is sometimes missed, is that married couples or civil partners can share effectively those allowances together. So for example, in another alternate universe, let's assume you and I are married. I've got a portfolio and an investment account, and I've got £6,000 of gain. Now, what I can do is I can assign you, depending again on the platform, I can assign you some of those shares or some of those funds so that I can sell and utilize my £3,000 allowance, but also you can as well. So instead of me doing it and crystallizing a gain of 6,000 and paying whatever percentage of tax that will be on £3,000, I can pass it over to you. Yep. You can do the same thing. And actually we get all that money back out and we don't pay a penny in tax. So again, it's just about understanding what options that individuals might have on the table to enable them to potentially explore tax efficiency, because that is what this is. It's being as efficient as possible with what you've got, looking at all the options on the table and thinking, actually, do I want to do this? Is this an option? What else can I do? This is my bill. Jack, James, can you help me out? What can we do here? You know? So yeah, that's probably the big thing that I find a lot of people either aren't aware of or don't do. Obviously there's a bit of admin involved, and sometimes it's a little bit tricky to do it. But as you say, I think if we do come into a world where potentially capital gains allowances are completely removed, I think the last sort of rumor was it was dropping to 1,500. At that point, we're kind of at zero anyway. I mean, it's hardly anything, is it, when you're looking at it in a bigger picture? But yeah, I guess we just got to wait and see. I mean, the budget coming up in the next couple of months will tell all. But I think the key thing I always sort of say to people is it's very rare that these things are in place overnight. If we go back to 24, there was a big sort of commotion about the that was a huge change. We talked about this in previous episodes. And a lot of people panicked ahead of that, thinking that it might come in overnight. And actually, it was a 2.5 year consultation process. And we found that people were actually creating problems for themselves that they've actually had 2.5 years to think about and plan for. So we always kind of have that in there to say, look, if we do find that there's rumours, a bit of conjecture around what may or may not be happening, it's just to take that little bit of a breather and think, actually, is it likely that I have to act on this today because the budget's later, overnight, 24-hour period, I'm in a different, it might not be that way, you know?
Yeah, we'll have to see. One of the cheesy phrases I always like is, don't let the tax tail wag the investment dog. That's one of my favorites. And and really what that means is just because you're going to incur tax on something doesn't mean you shouldn't then sell that thing. So for instance, some people have got, investments and they're looking at a big gain on it. So I won't sell that. I don't want to incur the tax. But actually, if those shares aren't right for you, then it's worth it may well be worth incurring the tax to then reinvest it into something that does suit you. Yeah, and I think that's similar with the GIAs as well. It's like when we're looking at these tax situations, it's a case of just reviewing it, just thinking about it. Because the one thing with the GIA, unless you leave it until you die, at which point at the moment, there's no capital gains on death. That money's going to have to incur tax at some point. Yeah. So I remember, Martin, the founder of Lumin, always says, it's like, well, when you look at someone's GIA, it's a case of, right, well, okay, well, there's the value. It might be 300,000, but then, well, what's the actual real value after tax?
Yeah, because the net of it, right? It's like that gross and net income sort of conversation, right?
So in reality, it's like, if you're earning 100 grand, you're not really earning 100 grand, you're earning 60, 70 grand, whatever it is. In that's the thing. So it's a case of understanding what the tax burden would be, using all those allowances, like you said, using your capital gains allowance, potentially shifting funds between partners, spouses. I think that's the key things, really. Yeah. Is there anything else you wanted to pick up on, Jack?
No, just that point there you mentioned about capital gains tax dying on death. And actually, we have this quite regularly when we deal with potentially older clients as well that might have been sitting. You see it quite a lot with potentially more old school ways of working where people are sat on lots of shares with a company that they were awarded by working there. And obviously, that's potentially up to even 40 years I've seen in the past. And the gain on those is absolutely insane. So again, it all boils down to the circumstances, but sometimes it's a good idea to leave it and just let the shares pass down once. It sounds a horrible thing to say, but once there's been a death in the family and those shares are then distributed as per the wishes of the will, etc. And you get around the sort of tax on the capital gains that side. There may also be inheritance there, of course, but it's about limiting that exposure. Yeah,
it's like that double tax, isn't it? If you sell it and then say even you sell the shares, incur the capital gains, gift the money, but then if you gift the money, you don't survive 7 years. Then you've been hit twice. You've been hit twice, capital gains and inheritance tax. Well, on that positive note, Jack, we'll call it to an end here.
Good way to end
Yeah, so thank you very much for your time today.
No problem. Great to see you as always.
Thank you very much for listening today. And as always, everything we've discussed here on the podcast is for information purposes only and should not be treated as financial advice. If you'd like to seek financial advice, then do please come to us at luminwealth.co.uk.